As a day trader or scalper, I'm sure you enjoy the thrill of the market open, especially during the first hour of the London and the New York sessions. The rush of adrenaline as we watch the price move up and down, the anticipation of the next big trade, and the fear of missing out an opportunity are all part of the experience. Today I'll talk about this, trading the market open, and several strategies to apply in the first hour of trading. Like, subscribe, and stick around for the full video. Your emotions and psychology play a critical role in how you approach the market during this critical time. The first hour of a trading session is known to be one of the most volatile periods of the trading day. This creates an intense activity and movement in the market, which can be both exciting and intimidating. One of the primary emotions that you may experience during the first hour of a trading session is fear. This fear can arise from a variety of sources, including the fear of missing out on a big trade, the fear of losing money, or the fear of being wrong. Another emotion that you may experience during the market open is greed. This can manifest itself in a variety of ways, including the desire to make a quick profit or the desire to take on more risk than is appropriate for your trading strategy. And if you allow greed to drive your decisions, you are more likely to make mistakes and take unnecessary risks. The point is, in order to be successful during the first hour of the London or New York session, it's important to approach the market with a clear and objective mindset. This means setting aside your emotions and focusing on facts and data presented by the market. When it comes to trading during the market open, one of the most important skills you can have is the ability to identify key trading levels. The main problem you may face when trading during the market open is the volatility and the unpredictability of the market. Prices can move rapidly in either direction, and it can be challenging to know where to enter or exit trades. This is where identifying key trading levels becomes crucial. There are a variety of different methods that can be used to identify major trading levels during the market open, including supply and demand areas, trend lines, moving averages, or classic support or resistance levels. Each of these methods has its own strengths and weaknesses, and it's important to use a combination of different tools to get a complete picture of the market. These tools can give you a good idea of where prices are likely to bounce or reverse during a market open. During London or New York session open, your goal is to find some sort of edge that can help you make better decisions. One approach is to use pivot points as a tool to identify key price levels. These are calculated based on the previous day's price range, and they offer you key levels to watch for potential price action. During the first hour of the market open, price action is unpredictable. However, by using pivot points, you can gain a better understanding of where price may potentially move. It all starts with a daily pivot point. This level can serve as a reference point for potential price action. If price opens above the daily pivot point, you should look for potential buying opportunities at support levels. If price opens below the daily pivot point, you look for potential selling opportunities at resistance levels. In addition to the daily pivot point, you should also be aware of the S1 and R1 levels. These represent the first support and resistance levels of the day. Look for rejection or continuation patterns at these areas. If price breaks above the R1 level, you may look for potential buying opportunities. If price breaks below the S1 level, you can search for potential selling opportunities. So don't ignore pivots during the market open. If you're trading indices or stocks, you'll often find gaps at the beginning of the session. Market gaps can be both exciting and intimidating. On one hand, they offer the potential for significant profit in a short amount of time. On the other hand, they can signal a change in the market direction and cause panic among traders. And it's important to have a strategy in place for trading based on these gaps. One simple strategy for trading gaps is to wait for the market to establish a direction after the gap has occurred. This means you don't rush and wait for a few minutes after the market open to see if the gap will continue or if the market will retrace back to fill the gap. If the gap continues and finds a key level, a pivot point maybe, you can look for opportunities to enter a trade in the direction of the gap. If the market retraces to fill the gap, you can look for opportunities when the gap is filled. When a gap occurs, it can create a new level of support or resistance that the market may test. By identifying these levels, you can enter trades in the direction of the gap or against it, depending on the market reaction to these levels. During the first hour of trading, the market is usually highly volatile, with prices moving rapidly and traders scrambling to enter and exit positions. This is where volume can help you. When volume is high during the first hour of trading, it can be an indication that there is strong buying or selling pressure. This can confirm the direction of price movements. For example, if a market is experiencing a price increase during the first hour of trading and the volume is high, it can be an indication that there is strong buying pressure in the market. This can be a sign of a strong uptrend. On the other hand, if the price is rising but the volume is decreasing, this could indicate that the trend is losing momentum and a reversal may be imminent. If the price is falling and the volume is increasing, this could indicate a strong downtrend, while a falling price with decreasing volume could signal a weakening trend. Another way to use volume to identify potential trades during the first hour of trading is through volume spikes. A volume spike is a sudden and significant increase in trading volume that can be an indication of a potential market move. In addition to volume analysis and volume spikes, you can also use volume indicators to help you confirm price movements during the first hour of trading. Traders fall victim to liquidity clearouts and stop-loss hunting time and time again. This can be especially damaging during market open, when the market is most volatile. Liquidity clearouts occur when large institutional players enter the market at the opening bell and take positions that are significantly larger than the market's available liquidity. This creates an imbalance in supply and demand, resulting in a sudden and sharp movements in price. Stop-loss hunting is another tactic employed by market players during the market open. This involves intentionally triggering stop losses of retail traders in order to create price movements that will benefit their own positions. The key to protecting yourself from these practices is to have a solid understanding of market dynamics and to be prepared for sudden movements in price. One risk management measure that you can use is to avoid placing stop-loss orders at obvious levels. Market players who engage in stop-loss hunting are often looking for these obvious levels. So by placing a stop-loss at a less obvious level, you can reduce the likelihood of your positions being liquidated. One indicator that can be particularly useful during the market open is the opening range breakout indicator. This tool will help you identify potential breakouts at the beginning of a trading session. It works by calculating the high and the low of the first few minutes of trading, and then using these levels to identify potential breakouts throughout the rest of the session. You first need to determine the length of the opening range. This is typically the first 5 minutes of trading, although it can vary depending on your preference and the market being traded. You can set it at 15 minutes or even 30 minutes. I prefer to set it for the first 5 minutes after the market opens. Once the opening range has been established, You can then use the high and the low of this range to identify potential breakouts throughout the rest of the trading session when price breaks above or below the high or low of the opening range. And of course, not all breakouts are created equal. Many breakouts may be false signals, and the price may quickly return inside the opening range. You need to be able to distinguish between genuine breakouts and false signals. And this is where your ability to read volume, to find confluence between key levels, to find liquidity clearouts, to read pivots will help you find a trade. My own preference is to watch for the opening range to develop and allow the other traders to fight against each other until one side wins. If price breaks above the high of the opening range, I wait for it to establish itself above or below the breakout level for several candles before entering. If the opening range holds, I may choose to enter a long position with the expectation that the price will continue to rise. If I see that price is breaking the upper range and then immediately returns inside the range and also breaks the other side, I may look to short the market if I see that the lower line of the range is acting as resistance. If you want to learn more about the opening range breakout, make sure you watch this video. If you're trading currency pairs or indices and you have access to extended hours, you could also trade the London Open using the Frankfurt session activity. Frankfurt trading session starts at 7 a.m. GMT and the London session starts at 8 o'clock GMT. This trading hour between 7 and 8 o'clock GMT will give you many trade opportunities at the London Market Open. And you don't have to draw this range yourself. In TradingView, you add this indicator, FX Market Sessions. You'll keep only the London tab, and you'll hide the rest of the sessions. Now it displays only the London session, but we want the indicator to draw the range from the Frankfurt Market Open 1 hour earlier. If you look at the indicator's default settings, at the start of the London session, it shows 8 o'clock GMT. We want to highlight the price action 1 hour earlier. So in the first tab, we'll select the Frankfurt Open, 7 o'clock GMT. And you put 8 o'clock, the London Open, at the second tab. The high and low price of this range are the first support and the first resistance of the trading day. The trade plan is to find imbalances in the market at the start of the London session. If price goes above the range, it's a sign of strength, and you look for buying opportunities. If price goes below, it's a sign of weakness, and you look for short signals. And you don't trade when price is inside the channel, because there is no imbalance between buyers and sellers. If you want to trade the New York session, the same process. You want the indicator to draw the range prior to the New York Open. You'll keep only the New York tab, and you hide the rest of the sessions. And now it displays only the New York sessions. If you look at the default settings, at the start of the New York session, it shows 1 p.m. GMT. We want to highlight the price action 1 hour earlier. So in the first tab, we'll select 12 o'clock. And you select 1 p.m. GMT, the New York Open, at the second tab. And now you have the range prior to the US session. Again, you find imbalances between buyers and sellers above or below the channel, taking into account volume, pivots, liquidity traps, and so on. If you want to see an in-depth video about this strategy, you definitely must watch this video. And check out our Academy program if you want to further level up your trading. Until next time.